So we're now seeing the stock market higher than it's ever been before in history, which is mainly caused by... Hey, what's going on everyone? It's Griffin here, and boy has it been a long time since I've made an update on the stock market. But with everything that's happening right now regarding interest rates, the S&P 500 surging to all-time highs, Bitcoin seeing a massive rally leading up to the halving event, well, I thought that this would be an opportune time to do so, as a lot of people have commented over the past couple of months that they miss some of my old style market analysis videos that ultimately are what grew my channel the most way back in 2021. So let's get into it. We do have a lot to cover in today's video, and if you have a moment though, please leave this video a like. It really helps me out and it's free. All right, so let's start off with a higher level stock market update to give you some more context about what we're dealing with here. So right off the bat, the S&P 500 and the NASDAQ 100, two of my favorite market indexes, are respectively up 25.5% over the past year as of the time of filming this video, and that is for the S&P 500, which is a phenomenal return considering averaged out over the past 50 years, the average annual returns of this market index tends to be around 11.13%. Now, following the 2020 market crash, the S&P 500 experienced a roughly 107% trough to peak rally fueled largely by those rock bottom interest rates implemented by the Fed, and then also stimulus being injected into the economy, which we all know was, great for stock market returns during this period, of course, but ultimately did lead to other economic issues like drastic inflation levels not seen since the 1980s, which then forced both the Fed and Bank of Canada to implement a succession of rapid interest rate increases to effectively calm down this rampant inflation, which had the desired effect on inflation levels despite not yet being back down to that 2% annual target. So from that market peak experienced in February 2022, though, the American stock market, specifically the S&P 500 in this case, saw a 2-year valley of diminished and stagnant returns for those long-term investors to now having gained some new momentum and be peaking once again at all-time highs, which brings many economists and investors to wonder what may lie ahead in the future of the markets. And to that, I'll be the first to say that despite anything that you might read online about market predictions, even this video to an extent, although I'm not making any predictions though, well, all of this is speculation. And ultimately, no one knows where the markets are headed except certain policymakers and politicians, but that's a different story altogether. But nonetheless, I've always found it interesting to look at certain market indicators that could give us clues as to what may lead ahead. So let's take a look at some of these right now. All right, so first and foremost, let's talk about where most of these gains in the American stock market are being derived from. And the short answer is big tech, as with most of the returns experienced in the US stock market since the mid-2000s, which are ultimately what have allowed the S&P 500 to experience a 500% return since 2003. Companies like Nvidia, Apple, Microsoft, Meta, and other American tech giants have seen gains over the past couple of years that are staggering by any metric, and especially considering their sheer size to begin with, which is actually a phenomenon that I spoke about a couple of years ago on the channel that I got out of this book right here called Post-Corona by Professor Scott Galloway, who essentially speaks about how the pandemic changed much of the economy, specifically in regards to big tech's role and influence. For example, he states that yes, while lockdowns intended to curb the coronavirus led to an economic recession, causing major companies to declare bankruptcy and unemployment rates to surge during that time, well, this was while big tech companies experienced significant gains actually. Additionally, the pandemic accelerated the dominance of technology in our everyday lives, especially benefiting those big tech companies once again, contrary to predictions of a subsequent decline where the rise of these companies appears now sustained, and that was a couple of years ago already. Things have definitely played out quite accurately here. Finally, he notes that big tech companies follow a strategy of innovation, obfuscation through advertising, and then going ahead and exploiting their advantages to achieve substantial gains in the market. Again, all of this has proven to be true. Now, in terms of major gains in the US stock market being attributed to the tech sector, this is clearly seen by looking at the performance of other sectors in the US stock market as follows. The Dow Jones US Healthcare Index is only up 7.9% in the past 3 years. The Dow Jones US Airline Index has seen terrible returns over the past 3 years. The S&P 500 Energy Index is also down 1.6% over the past year. You get the point here. It's really the information technology sector that leads innovation in the US at least and creates the most economic output, at least in regards to publicly traded companies. And that leads us to talk about GDP growth since the pandemic. All things considered, I think a lot of economists and the Fed even have been surprised at the continued GDP growth despite higher interest rates that should cool down the market. In fact, despite the huge drop in gross domestic product, GDP, during the pandemic, the US economy has rebounded very rapidly and well, now having reached levels that are up 9.2% above pre-pandemic levels, which truly is a testament to the resiliency of the market and ability to bounce back from disaster. So while there are long-lasting financial impacts left by the pandemic, of course, the economy itself has rebounded very well and is growing at a consistent pace once more, which is of course felt through in the stock market as well, especially considering that this is during a time where interest rates do remain higher for the time being, most likely gearing up for some rate cuts though over the next 12 to 24 months, which realistically should help stimulate the markets even further, but that's yet to be determined. Additionally, in parallel to lower interest rates that might be on the horizon, there's still a ton of cash that's sitting in money market funds on the sidelines that could very well continue to be invested during dips in market growth, which doesn't inherently mean anything, but still points to the ability for the market to run further if it wanted to. Okay, so with that said, market peaks and troughs are common in the stock market, and again, predicting their timing has proven unreliable, which is why as long-term investors, we shouldn't base decisions on market timing, as historical data suggests numerous peaks will continue to occur over the coming decades, which is why, although it does sound boring, staying invested through these fluctuations is just crucial for long-term prosperity, considering the likelihood of hundreds of market peaks in the future. And while market downturns can be significant and feel really detrimental in the time being while it's happening, let's just remember a couple of years back, well, the overall trend since 1926, so 100 years worth of market data, has been on an upwards trend, with occasional setbacks, of course, that should be viewed as opportunities though to dollar cost average as you continue to make contributions to your stock market portfolio. Now look, I know that I haven't made a stock market update video in a while on the channel, and this might seem like relatively generic information, but that's because my views on the matter simply haven't changed for years. And as much as I've had viewers comment that I have no idea what I'm talking about, etc., well, look at the market now, right? I've been talking about the stock market on my channel since back in 2018, and I've been investing since before then. But although individual companies do come and go over the years with varying levels of returns, well, investing in the general market utilizing broad market ETFs has always been something that I've spoken about on the channel, and that is relevant for 95% or more of retail investors. At least that's what I believe. Individuals who aren't out here, making a living out of stock analysis. Like, just take a look at this video right here that I made back in 2019. At that time, the VFV ETF, which tracks the S&P 500 here in Canada, was trading at around $68.50, while currently it now sits at roughly $123. So literally doubling your money here, and that's with zero effort. This is one of the most passive and easy to invest in exchange traded funds available, by the way. That being said, looking at the average PE ratio of the S&P 500 right now does show that it is much higher than historical averages. However, we do need to consider that a much higher concentration of the index is now held in big tech IT, which does command a much higher average PE than, say, industrials or consumer defensive stocks. So my point is this: there's a reason why I don't make as many videos about the general stock market anymore, and that is that I truly feel like for most investors, especially people who do watch YouTube videos about investing, to be fair, should just invest in broad market index funds like the S&P 500, the Nasdaq 100, maybe a high interest dividend ETF, continue making those periodic contributions to these positions, and then just forget about them because they essentially represent the economic prosperity and growth of America. And hey, if you don't think America will continue to thrive, well, that's a different story altogether. Otherwise, tracking all of the little ups and downs though in the market is mostly just noise that most long-term investors that are saving for retirement don't need to worry about. You're much better off spending your time actively working on a new business or income stream that can just then be used to invest further into your passive positions. Oh, and hey, by the way, if you want to learn more about how you can create your own stock market portfolio on your own, then I'd highly recommend that you check out my fully free stock market investing course over on Skillshare. It has over 7.5 hours of content in it and now has over 2,000 students, which is absolutely incredible. And again, totally free for you to check out if you're interested. Link down in the description. Additionally, if you're new to stock market investing and need to open up a brokerage account, check out the links down in this video's description where you can get a massive sign up bonus on Moomoo, which also has insane free research functionality built right in. So thanks a lot for watching today's video. If you enjoyed it, don't forget to leave a like. And with that said, I'll see you in the next one.